All right, I think we're live. All right, guys, welcome back. Happy Wednesday. Jeb Smith, real estate broker here in Southern California, and we have our esteemed guest with us once again, Josh Lewis, Bywise Mortgage. Josh is my local lender here in Southern California, does a lot of loans for a lot of you guys. So if you're looking to do something in California, Josh is the best contact for you. But with that said, we appreciate you guys joining us tonight. As always, this is built around your questions, right? We're here to answer your questions. We're going to talk a little bit about the housing market, about interest rates, about some trending news that's going to affect all of that. But, you know, we really want to help you guys get through the process, whether you're buying a home, selling a home, or just want to know what's going on in the market. So use that box there to the right of the video, comment, might be below the video, whatever it is, and comment, ask your questions, and we will get back to them as quickly as we can. So this week, Josh, we got, well, actually, as of yesterday, we got some news on FHA with regards to DACA. I think we'll kind of maybe keep that just for a little bit, wait for some people to get on the channel so we can talk about it in a little bit more detail. But why don't we start by talking about rates, right? If you look at the news headlines, the media is out there saying that rates are on the rise and so on and so forth. But you and I were having a different conversation. So let's hear where rates are this week.
That's why the headlines are always dumb. 99% of the time when you see something quoted in the news, whether it's on a website or if you still go the archaic way and pull up a newspaper, it's coming out on Thursday and they're quoting Freddie Mac's primary mortgage market survey. It's basically giving you a look back at all the loans Freddie Mac purchased the 7 days prior. So it's already out of date. You know, we talked last week that rates had gone up a little bit, and yet the headline from last week was, hey, rates reach an all-time low. So you're always just about a week behind. So we've seen improvement every day this week, still not back to where we were at the start of the year, but from the start of the year to a week ago, we had gone up about 0.25% a week. So rates are still 0.1% higher. We had got down where we were locking the absolute best borrowers at 2.625 with 0 points and 0 fees, and now that's up to about 2.75. So still very, very good. The FHA and VA rates are still insane. One of the things, if you have a VA loan, you're probably getting your mailbox stuffed with flyers talking about incredibly low rates. We have lenders talking about 1.75 30-year fixed rates on their rate sheet. For the most part, they cost too much. No one wants them or would be eligible for them. But we see crazy numbers of 30-year fixed rates under 2% on lenders' rate sheets. But government loans, primarily in that 2.25 to 2.5 range, whether you want it zero cost or whether you want to get a credit 0 points or whether you want to get a credit back from the lender, 2.25 is pretty safe for most borrowers. So long way of saying, it's like Groundhog Day, more of the same. Rates have been low. They've been really good. Don't look at the headlines because the movement that we've seen is so minimal as to not make much of a difference.
No, good stuff. And so, you know, I think it was surprising to a lot of people. So yesterday I posted a video where I discussed FHA versus conventional. We broke down, 3% conventional, 5% conventional versus an FHA at 3.5% down. And I'll link to that video here for anybody watching this after the live feed. But, people were surprised to see how low the rates were with FHA. One of the common questions was the credit scores are going down, between 640, 680 and 740, I think is what we did. But the rate was the same across the board for all three credit scores with FHA, where you saw a big variance in interest rate across those conventionals with those credit scores.
Absolutely. So that's the biggest difference, is not only do the interest rates go up as the credit scores go down on a conventional loan, the mortgage insurance rates go up. So when you're down around a 640, so I think if you look at that video, the 740 borrower with 5% down is paying really low mortgage insurance, like 0.5% or less. So you're saying relative to the FHA, the mortgage insurance is cheaper. And so people will go, well, FHA mortgage insurance is so high. You go, well, you have a 650 credit score. Let's show you what your mortgage insurance looks like. And it's up at 1.3, 1.4% for people with low credit scores. So not only are you paying a higher rate by about a full percent, then you're paying another 0.5% higher in mortgage insurance. So anything under 680, I will always show our clients side by side, because it doesn't really work to just say, well, trust me, you don't want to do conventional. We actually had an email that someone was told that today, and they're like, I don't want to work with that person. They don't even want to seriously answer my questions. So you always want to show that side by side, and people are amazed when they see the number, because I can tell you anything under a 680, the FHA is going to be a better option. One of the things that I always like to talk about, or people say, they come with one bias or another. They'll come and say, I want an FHA. FHA is the greatest because of X, Y, and Z. Or they say, whatever you do, do not talk to me about FHA. I don't want an FHA. They're terrible because of A, B, and C.
Right.
They're neither. They're not great. They're not terrible. They are what they are. We want to look at all your options, compare and contrast. My cousin up in Idaho is actually buying a house right now. We won't say what her credit score is, but it's one that the FHA is much better for her. And I'm talking to her aunt, or my aunt, her mom, and she says, well, FHA sucks. You have to pay 1.75 up front, and then the mortgage insurance is on there forever. And they said, okay, well, the other option is to pay a percent higher in interest rate and 0.5% higher in mortgage insurance. So that 175 upfront mortgage insurance fee on an FHA loan, you're paying that extra every year on the conventional loan. So let's not say it's good, bad, or terrible, great. It is what it is. Let's look at all of the options. The numbers don't lie. They will speak for themselves.
Well, yeah, I mean, agreed, right? I mean, I think the number one thing that people comment on videos is about the mortgage insurance, right? That it's on there forever. And, but what people fail to realize, and what we always talk about, is the majority of people don't have the same loan more than 5-6 years. So the chances, regardless, even if you get a conventional loan, it has mortgage insurance, at some point, you're going to either have to refinance to get that off, and or get enough equity in the property where the lender drops it. And in order to get that equity, it's going to take some time. So, chances are you're not going to have that loan for an infinite period. Most people don't hold the same loan for 30 years these days. So, that's why it's less of a concern for a lot of people. So let's get into a couple of, what's that?
Yeah, I was going to say, look at that. Look at the first question here, or the second question. We can get to Stephen, but it's a good follow on here. So this is a perfect example. So the question is, what if you're buying a second home? Is a 680 credit score good enough for conventional? Like, absolutely good enough for conventional. And if we're sitting here saying, is FHA the best or the worst? Is conventional the best or the worst? In this situation, you can't use FHA to buy a second home. So it's not even an option. So conventional is the only option. So whatever it is at 680, if the rate is higher, if this is less than 20% down, and so we have mortgage insurance, the mortgage insurance is higher, it is what it is. That is the option to do that transaction. So the only other options we have are, can we improve the credit scores, or something on there we can fix or repair or bring the scores up? So it's important that for me as a loan officer is to know what all the options are, know what the differences are, and ask the borrower all of the right questions. I have a client right now. She's buying a new home, a new second home, very similar to this question here, out in Palm Desert. And they're making her, it's new construction, so they're making her qualify with the in-house lender. And the lender says, okay, your mortgage insurance is $122 a month. And I said to the borrower, I said, okay, so she knows there's two of you and she knows what your credit scores are? Because no, she didn't ask any of that. Well, you can't know what the conventional mortgage insurance is, because unlike FHA, which is 0.85 across the board for minimum down FHA, on a conventional, two borrowers pay a lower mortgage insurance rate than one borrower. Credit scores matter in every 20 point increment all the way up to 800. So if they don't know that, you can have a really, really, really low mortgage insurance rate on a conventional with two borrowers with 800 credit scores, or you could have a really high one with one borrower with a 650 credit score. So there's a lot of people that just talk off the top of their head and say, well, it's about this, well, it's about that. Especially, I mean, nationwide now home values are high, but in California, home values are so high that a little difference in a mortgage insurance rate, in an interest rate, makes a real difference in your monthly payment. It's important that as lenders that we speak precisely and accurately. And if you're giving someone a broad range, you let them know, hey, this isn't a specific number and it could make a big difference. I need this information from you to be able to give you the accurate information that I think you want to have.
No, and agreed 100%. The one thing I got from that statement is that, again, make sure you're working with a professional. Real estate, mortgage, both. You should have somebody that can break these things down for you, have that conversation, right? Because a lot of people out there, unfortunately, as we've said, the barrier to entry to enter this business is pretty low. So, make sure on your side you've got the right person working on your behalf. Otherwise, you could end up with a Yahoo telling you wrong information.
And here's the numbers that I tell people. 80-20 has never been truer. 80% of real estate professionals and loan officers are worthless, that you would not trust your friend or family to get a loan from them. The good news is there's so many realtors and there's so many loan officers that with 20% that can do a good job for you, you can find plenty of good ones. I talked to a guy from the channel yesterday that he's looking at buying his first home here in LA. We had a great conversation, and he had talked to me that his brother-in-law flips homes for a living, and he has a broker that he trusts and works with, and he had a great conversation with that person too. And I could tell from the conversation that they had, it was a good loan officer. I said, here's the good news. I don't care if you use me or use them. I care that you get a good loan. If you're good at what you do, we should all have enough business that it's not about getting another loan and winning or losing. It's just make sure that the 80% of people that are not doing a great job for their clients are not getting a hold of people and misleading them, taking them way into a transaction and finding out either they don't qualify or they qualify for something different or for a much higher payment or cost than what they're originally sold.
No, absolutely. All right. So Steven here, housing market's pricing me out of my state. Disabled veteran trying to get a decent home in Las Vegas is tough. I would have to sink in 30 to 40 grand in repairs. Really hurts. Yeah, Steven, the market is tough. Not just in Vegas, but everywhere. But fortunately with VA, being a disabled veteran, you get, some perks there with VA, not having to put any money down. You can also not have a funding fee up front. And you get the best of rates. So, it's, thanks for your service. So,
no, absolutely. That 2.25% interest rate with zero down and no funding fee, you can qualify for a lot more than you can elsewhere. And I'm not promoting this or saying you should do this, but VA also doesn't have a written maximum limit for your debt to income ratio. We had a client, you and I here, Jeb, in Huntington Beach last year, we had a 68% debt to income ratio. And in his situation, he was comfortable doing that. His girlfriend was going to be living with him. He had another undocumentable source of income. On paper, it looked crazy, but VA gives you a lot of leeway and flexibility. So again, not saying run out and get a VA loan with a 68% debt to income ratio, just pointing out that they give you a lot of flexibility and leeway to determine what you can afford.
I had no idea. All right. So let's go to Joe here. Joe's got a good question. Self-employed for 8 months, makes around 10 grand a month. Can he buy a home with a credit score of 838? So I think if you watch my videos or anyone else's videos out there, we're usually talking about 2 years of verified employment, stable income, stable employment. So what Joe's asking is, hey, I've only been self-employed for 8 months. Josh, jump on that one.
There's some interesting guidelines around this. So if we're talking FHA, VA, Fannie, Freddie, you're going to need at least 1 full year on your taxes. So when can we get around it? And if we can't meet that, what options outside of Fannie, Freddie, FHA, VA exist? So there's always exclusions for business purpose loans. If you're buying a property for an investment, they still have stated income loans for that type of stuff. Sounds like we're talking about occupying the property, so we don't have that. We have to follow the ability to repay guidelines. You actually have to qualify. So at 8 months, it's still probably a little bit early because on a bank statement program, even though we have lenders that will take 6 months average deposits as qualifying income, they generally want to see that the business has existed longer than that, but that would be a possibility. Looking longer term, if you said, when can I get myself into a position? FHA and VA are always going to require 2 full years of tax returns, so it's going to be a while. Fannie Mae and Freddie Mac will sometimes allow 1 year tax return. For Freddie Mac, if the business has existed for 5 years or more, you only need 1 year tax return. Cool, simple, black and white rule. Fannie Mae leaves it up to Desktop Underwriter, their automated underwriting system. So we put in all your information, we run it through, and it comes back and it asks for 1 or 2 years tax returns. So in the best of all possible worlds, next January, you're able to file that tax return and you have a good full year of earnings there and you get a 1 year tax return. That would sort of be your best case. The other would be to talk to a lender about potentially doing some type of bank statement program.
No, good stuff. I didn't realize that with Freddie Mac and LP that it 5 years would the drop dead or allowing you to do 1 year. So good info.
And they're very specific in how you document it. You can't just get a CPA letter that says, yeah, trust me, they've been in business for 5 years. You have to show it's been around.
No, good stuff. All right. So Scott, Soccer Legacy has a question. What happens, you can see how I could get confused there. What happens to those who go on mortgage forbearance, put their payments on the back of their loan, but then try to sell their home before 30-year loan is up? Will they have to pay the months they took? The answer is yes. So whether you refinance, keep the loan for 30 years, sell the property, whatever you do, those payments that you added to the back of the loan have to be repaid in some form or fashion. So if you refinance, you can pay them off through, pulling cash out or what have you. You sell the property, it's just, the lender pulls, your payoff demand, if you will. Those past due payments are going to pay off, are going to show up on that payoff demand, and it gets paid off through the close of escrow. So yeah, you're going to have to pay it back one way or the other. It doesn't go away. The loans that we're doing right now. The loans that we're doing right now for people who took forbearance, what we're primarily seeing is on the payoff demand. It says the primary principal balance, and then it says deferred principal balance, because that's the way most of them are doing. They're just putting it onto the back of the loan. So for you, it's no skin off your hide for now, because it's sitting there just on the back of the loan. It's not accruing interest. Most of them, it's just those 3 months, 6 months, 9 months of payments are just sitting there. All right. Let's go here. Sharwin is, how do I negotiate middle ground on an inspection contingency? Had quotes from a contractor and sellers had another to look at the issues brought up. Big difference in price. So it's one of those things that, right, this is not advice. Just talking to you as I would anyone else. It's a fine line, right? Because what happens is, as a buyer, repairs come up, you're going to go get your contractors and they're going to come up with a price. The sellers might or might not do the same depending on where your numbers come up. But what happens is, the seller is trying to get away paying the least amount for those repairs, and you're just want the repairs completed. So maybe you do a third party to negotiate and see where they lie, and then use that as kind of the determining factor between the two. Or maybe there's some sort of splitting in between to make sure that that there's enough money to cover it, and that the bids that they're getting are realistic bids and what have you. I mean, at the end of the day, if you can verify that the information that the seller's providing is accurate, and you can do the same work, and those people are willing to do that work for that cost, then maybe you can get away with not, with the seller's bid, but maybe a third bid in there is maybe the best way to go. And that way you have, one of theirs, one of yours, and then maybe, somebody that you guys can decide on mutually to get another bid and see where a realistic number is. At the end of the day, it all comes down to like the art of negotiating. I mean, you want to get away with just getting the repairs done. They want to get away with the least out of pocket. So what can you guys do to meet in the middle, per se, to make both parties happy? And there's not always an easy way to do it, but you also have to use leverage on your side. I mean, does the seller want to take their house back on the market? Are they moving? Do they have timelines that are important to them? Because if they do, then you can use that in your favor, right? I mean, if you're willing to walk away, if you're truly willing to draw a line in the sand, and if they don't agree, walk away, then use it. Right. And if you get your way, great. If you don't, then you move on. But it can become one of those emotional things. But Josh, anything you want to add on that? No, I think you're right. Either negotiate to split the difference, or agree ahead of time that, hey, here's someone that neither one of us have a relationship with that we would like to come in and estimate. Before you jump in, and we've got another good one here. You want to jump on that one? I don't know which one we're talking about. It's on screen. Oh, I can't even see it. Hold on here. So it's just a question about appraisals. How much a factor is the CoreLogic estimate as on realtor.com versus nearby property sales and values?
any of the algorithms that you're seeing on Redfin, Zillow, Realtor.com, they have no impact on your value. That's just a proprietary algorithm that they use. Most of them are actually fairly decent and will get you in the ballpark. When you are having an actual appraisal and a professional appraiser is going out to your house, they are going to take pictures, they're going to measure your house, and they're going to look at it for quality, condition, amenities that you have, and then they are going to go and look at the list of comparable sales that they've already pulled, and they're going to drive by those, and they're going to look at the pictures online, and they're going to do their best to determine how yours compares to those, and they're going to do a comparison and adjust relative to those. So other than if you get an appraisal waiver, which the algorithms that are built into Fannie Mae and Freddie Mac's underwriting systems will determine what the value is. They don't even tell you what the value. They just say we accept the value that was input. Could be higher than what that is, just not lower than what was input. So
well, just I want to. You failed to mention the most important thing about Jennifer here. Jennifer gave us $5.
That's why I made sure that she got her question answered next, instead of having to wait for you to go and answer all of the questions.
Thank you to Jennifer. That might be the first one.
I believe it awesome.
Is. So Jennifer, you moved up to the top of the list. But no, I appreciate it. I mean, you always ask great questions too, which is helpful, because I think a lot of people, I mean, the nice thing about this is that when we address good questions, whether they're your question or someone else's, I think everyone benefits from that. So, at the end of the day, we're all here to learn. I mean, I'm even learning from different things that come up that Josh mentions or what have you that I'm not familiar with regards to financing. So it's a win-win. Let's see here. BTJDK. I bought my house. I felt like I was like rapping there.
You're not a good rapper.
My house in 2008 FHA, 45K. Wow, where do you live, man? I'm down to around 34K, or maybe a little less. Credit score is not good. One site says 631, but I think they are up from. Basically thinks the score is up a little bit. So did he comment somewhere else where he asked another question, or was that okay?
Yep, it's about 3 below.
All right. So don't know why insurance is high, over 800 a year. I want to sell him.
You went too far. He's got 3.
Oh Jesus. All right, you jump on there then.
So I called to try and get refinanced because my interest rate is like 5.65 or something like that. They said better off to pay extra payment here and there if I can. I'm on disability, anything I can do. And then what was the last piece of it there? I don't know why my insurance is so high, over 800 a year. I want to sell and move closer to my son. Leave me with the controls for just a moment. I'll try and get through all of them. So let's just go back. Probably the most important question here is, you called your lender, you have a 5.65% interest rate, rates are a ton lower than that, and you're like, why would they tell me that I shouldn't refinance? It's largely due to your loan size. So there's a simple rule of thumb that tells us when it can be beneficial to look into refinancing. So with a $34,000 loan amount, the rule of thumb is take $125,000, divide it by your loan amount, and that tells you how much you need to save. So with someone with a $500,000 loan, $125,000 divided by $500,000 is 0.25%. Now you're in the exact opposite situation. A $34,000 loan, $125,000 divided by $34,000 says we would need to save over 3% to justify the time, cost, expense, effort of redoing that loan. So probably closer to 3.5%. You'd have to get all the way down to 2% to make it worthwhile. The other piece of that, for a lender, there's almost no way to make money on that loan. And I don't mean make a lot of money. I mean $1. The way the federal guidelines are written, you are only allowed to pay so much for a loan. On a loan that size, just the cost of doing the loan, of keeping the lights on, paying your staff, exceeds what you're able to charge. So banks and credit unions in small communities will often do those. They're trying to build a relationship with their customers. For a company like us, it's really, really hard to even do it and legally be compliant. So you have a couple pieces there. It truly is probably not beneficial for you with the size of loan that you have. And then the second piece of it being that it would be really hard for a lender to stay compliant with federal regulations and actually be able to pay the cost of doing the loan.
No, that was good stuff there. All right. So that should be helpful. I'm going to go up a couple here because we missed one that in jumping around there. So Bobby Conklin is asking, first-time home buyer with inflation rising, do you think it's smart to buy now, even for a higher price? It might be good long-term since inflation will make the cost of the house lower. Right. So here's the thing. At the moment, inflation is not a problem. Will it become a problem in the next couple of years with stimulus and all this stuff pumped into the economy? Possibly. But the one thing that we do know is that real estate is probably the best hedge against inflation because it's a fixed cost. Your payment's going to stay the same, even with prices rising or whatever it is rising. So long term, real estate is a win. Now, the caveat is we don't know what happens to values and what have you in the future. Now, here in Southern California, I'm pretty secure with saying our market's probably going to be pretty strong over the next couple of years. But different areas of the country could be affected different ways. So it's hard to say that. But what I would say is if I was a first-time home buyer and I was looking to purchase now, if I wasn't extending myself, if I wasn't using everything I had in the bank, I was comfortable with the payment, I'd be all for it. But on the other hand, if you are doing those things and truly not in a position to set yourself up to buy right now, then maybe work on doing that prior to just trying to get in the market to be in the market. And Josh, you want to add anything on inflation?
Inflation is not now a problem, nor will it be anytime in the future. We've talked on the show why demographics are a strong factor in the housing market's favor as millennials are aging into prime home buying age. The population in general, other than that large millennial cohort, is decreasing in size, aging and decreasing in size. That means less productive. We have more of our population retired than working. You talk about all-in employment and fun numbers that they talk about every month when the unemployment figures come out. There's less people working, there's less productivity. The deficit spending that people used to always fear would lead to runaway inflation over the long haul actually takes money away from productive purposes and is deflationary. So for 1,000,001 different reasons, much like Japan has been trying to get some form of inflation over the last 30, 35 years, we're going to be doing the same for the foreseeable future. So for that reason, interest rates are going to stay low. Inflation overall is going to stay low. Home values have gone up largely because interest rates due to low inflation have made the monthly payments much more affordable. So home values are going to moderate at some point. They can't keep going up relative to incomes unless interest rates were to keep going down. So we need incomes to go up, continue to go up, or go up at an accelerating rate, or interest rates to continue to go down. We've talked ad nauseum here. I think interest rates are going to go lower. It may not happen this year, next year, or 3 years from now, but over the next 5 to 10 years, rates will be lower. So we're going to have those tailwinds for the housing market, but I wouldn't worry about inflation or try to factor it into a home buying equation of whether you should or shouldn't do it, because there's two separate things: inflation as a whole throughout the economy, and then home price inflation. We've had no inflation in the last 3, 4, 5 years, and home price inflation through the roof. So they're really two separate things.
Good stuff. Frank, looking for his first home. He inquired on a home via Zillow app. A rep got in touch with him to fill out a pre-qualification form. How trustworthy are these applications? Right. So I know some great mortgage professionals that advertise on Zillow. They're paired up with real estate agents. They're on there. So to answer, I don't know if the question you're asking is the application trustworthy, or is the mortgage professional trustworthy? And I'll answer the question of, is the mortgage professional trustworthy? Yeah. I mean, like anything, right? Some will be, some may not be. So, do your due diligence. If it's somebody that reached out to you directly, you have no relationship with them, just make sure, maybe check sources online, maybe ask a couple of people if they've heard of them, what their experience was, but also maybe do a little bit more work and get an approval or an opinion from somebody else, right? Maybe you reach out to another mortgage professional, something to compare it to, just to see communication, just to see how things compare to the person that was done, that got to you via Zillow. So, a lot of things have changed with Zillow here in the last week that are going to change the whole dynamic of the mortgage business. The real estate business in a sense. So, I wouldn't use Zillow as my sole option these days for searching for property or finding a real estate broker. I mean, a mortgage broker for qualification purposes. But that's a whole different conversation. So, Josh, anything on online Zillow guys?
So the big thing, what has been 2.5 years that Zillow bought a mortgage company and wants to be a mortgage company. So it used to be they sold advertising to mortgage professionals, and it was a crapshoot. You could get a great one, you could get a bad one. Now it's them. So they bought a larger call center operation, and they're trying to feed that. So for the most part, you're likely to get pushed to them. If you feel the need to go through an app, whether it's Rocket Mortgage, Zillow, whatever, for convenience or curiosity or interest, absolutely do it. But talk to a local mortgage professional. You'll notice a big difference in knowledge, expertise, and ability to help you. And if you don't, then either search for another one or stick with the call center. Most of the people that I talk to that have started with a call center operation were pretty underwhelmed, and we're happy to find someone that's been in the business a while and actually knows what they're talking about.
Just like anything searching online, just make sure you do your research on them, right? I mean, it's easy to show yourself one way online and then have a completely different operation behind the scenes. So just make sure you're doing your due diligence. Xavier is asking, are there first-time home buyer programs for people making over $85K a year in Georgia? Unfortunately, don't have the answer for you on that one, Xavier. You know, each state has their own programs broken down even to cities. In some cases have first-time home buyer programs. So, actual true first-time home buyer programs, it's hard to say. I would say, maybe check locally to see what you can find there. But, FHA, a lot of people consider that a first-time home buyer program because it allows you to put a minimal down payment. You could definitely qualify making 85 grand a year, assuming, your debt load and all that stuff looks good. But outside of that, any good way you think, Josh, to find first-time home buyer programs? I just know it's not easy these days.
You can do your own research. I wish I had the link right here. There's actually a website that will tell you all of the programs in your area, and generally with a link to the website, because some of them are statewide, some of them are countywide, some of them are specific for different types of properties. For the most part, the key part of the question is for people making over 85,000 a year. Most of them have some type of income limitation, and a lot of them, like ours here in California, they're indexed by family size. So if you have 10 members in your family, you can make more money than if you have 2 members in your family. So it really get connected with a local mortgage expert that has familiarity with buyer assistance programs, because not all of them do. Like if you were in California and said, hey, I want a buyer assistance program, it's not a personal area of expertise for me. Now, the key thing is we only have one down payment assistance left in California, really, and it's a pretty simple program. It's not hard to be an expert in it. So I know that one program, but I also have friends in other states that have 10 programs statewide, and they specialize in it, and they're really good at it. And I believe Georgia and most other southern states have multiple first-time buyer programs, and you'd want someone who specializes in them, not just a great loan officer that specializes in first-time buyer programs. And it's pretty simple. Just ask them, hey, how many first-time home buyer loans did you do in the last 12 months? If the answer is less than 10 or so, they're probably not specializing in it.
No, absolutely. He went on to ask the same question again. So we go to Steve here. So Steve's asking, how do you guys feel about the current and future of the California housing market? Because a lot of people are leaving California, terrible California policymaker, harming small businesses, et cetera. So I feel like I talk about this like 3 times a week.
Let me say this, Jeb. This is what I would tell anyone. Nothing that you're saying there is wrong. Those are all true facts, but there will always be a floor under California real estate, because if prices were to dip or drop much, there's no lack of people who want to live. We've got the Pacific Ocean about a quarter mile that way. People want to be next to that. They want to be where they can surf in that ocean in the morning and hit the mountain in the afternoon and snowboard. We have some of the most amazing terrain, in addition to culture, everything. So there's always going to be a floor under housing prices in California. Could they dip? Are all those things happening? Is it getting difficult? I mean, I've lived in California my entire life. I've thought about, if I were to leave, where would I go? I think Jeb's run through those numbers, and it's not easy. Despite the fact that all those things are true, you go, okay, so I gain A, B, and C by leaving, but I also lose like this big long list of stuff.
No, agreed. And to answer the question more direct, I mean, I think housing prices this time next year will be higher than they are now. I think that might be the case for the next couple of years. I'm not willing to go out there too far out at the moment because I just don't know what's going to happen. But I think based on the fundamentals of the market at the moment, basically just go back to your microeconomics class, supply and demand, and then you can play that into macroeconomics as well. I mean, it all works out, right? It's you have a little of something, a lot of people want it. You can raise the price on that product of whatever it is, and people will buy it, right? And they'll pay more for it than the next guy, and so on and so forth. And until that changes, real estate's not going to change. Supply is going to have to change, and interest rates are going to have to change. And in my opinion, neither of those are going to change in the foreseeable future. So for the housing market, I think if you're a homeowner, it looks pretty good. If you're a buyer waiting on the sidelines thinking that real estate is going to dip and you're going to buy, probably not looking so good. And if you're somebody that's selling and buying, then it's kind of a wash, right? But what you see is you have a lot of people leaving California. And let's be clear, if you're watching YouTube and you're seeing celebrities leave California, they're selling. A lot of these people own multiple properties in California. They don't just own one property. And so when they sell a property in California, that doesn't mean they've sold all of their real estate, right? A lot of these guys are keeping a home in California, buying property in, say, Arizona, the Graham Steffens of the world, these guys, and still coming back to California. That they're just not making their primary residence California. They're making it somewhere else because it's more tax friendly and what have you. And like Josh said, everything you said about California within that statement is accurate. I mean, the politics are nuts. It's crazy here, but we're all here for a reason. Mine's the weather, right? You could tell me I could get this weather somewhere else and be this close to the ocean, I'd move in a heartbeat. But that's not the case, right? And that's why we pay the prices that we do. So with that said, I think, it's not going anywhere anytime soon. And our boy BTJDK was from Kentucky. Oh, and a female.
Yeah, that's what she told you. She was a female, and you're accusing her of being your boy again.
All right. Sorry there. All right. What are we going here? There's a lot of questions. All right. So here's a good one. I get this one a lot. Does trade school 8.5 months count toward the 2 years of employment? So I guess the question is asked, if you're in college and you're taking classes towards a degree in a certain field, if you will, and I'm leaving college, or maybe I'm still, maybe I'm leaving college and I'm getting a job in that field of work. Can I count those years of schooling towards that employment history that's needed?
Yes, you can, and it's never completely cut and dried. Like the easy one is a kid graduates high school, goes to college for 4 years, gets a degree, and gets a job. We can use that straight away. It can be a different situation. We have a unique one here at the office right now. I want to say our borrower is about 30 years old. She went to school for 3 years, finished her degree, and then stayed home with her kid for a couple of years, and then went back into the workforce. And in that situation, we had to go back prior to her schooling and show that we had a 2-year work history. So if you're doing these things later in life and there's not that direct run, we just want to be careful with it. And you may need a full 2 years. And the most important thing, the school can count towards part of the 2 years, but the most important thing, like in this situation, our borrower, thankfully she met this requirement, needed to be on the new job for 6 months. We had to have that 6-month history of being on job for her FHA financing. So every type of loan program treats it differently, and I don't want to answer it with just the context of 8.5 months of trade school. We would want to see the entire work history.
No, good stuff. I'm going to go back to Joe here because Joe asked a question earlier about self-employed. I believe it was Joe asking being self-employed for 8 months and asking, could he get a loan? He has high credit score. And now he's going on to ask if he's using a cosigner, will that make the case easier to buy a house? He has a down payment, looks like $50K on a $350,000 house. So, maybe 12, 13%, 14% down or something. So why don't you talk about cosigners on loans?
So it's important to remember co-borrowers are not magic. They don't change anything about you. They can add to you, but in this situation, we can't use any of your income for qualifying. So a co-borrower would only help to the extent that they have enough income to qualify all on their own for this. And remembering, if they're not going to live with you, if they're a non-occupying co-borrower, we have to count their housing expense, whether they have a mortgage or rent, into the debt to income ratio. So you can have a really strong co-borrower, but it's not enough strength to bring to the table to cover all of their expenses and yours, considering we can't use the income. None of the additional strength of the co-borrower makes your income usable.
There you go. All right. Jesse's asking, had a VA loan, refinanced it 3 months ago to a conventional. Can I buy again in 2 to 3 months using my VA again? Thank you. So you want to jump on that one?
The answer is yes. Don't be surprised when you are asked to explain why you just did an owner-occupied refinance to the conventional loan. When you refinance, when you take any loan that's owner-occupied, you're signing an occupancy affidavit that says, I'm going to occupy this home as my primary residence within 60 days. Doesn't say I'm going to live there for the rest of my life, which is why you're probably okay in this situation. But you wouldn't want to do it right now, 2-3 months after the fact. You'd want to be 6 or 9 or preferably 12 months down the line. And it would help a lot if it made sense. If you wanted to buy the identical house across the street, underwriter might be shaking their head going, we're really just trying to acquire more property with zero down VA financing. And that does complicate it a little bit, that you are eligible for zero down VA financing. And to use it, you had to get out of the VA financing. It would be pretty easy to look and say, hey, I see why you did that. It wasn't to do an owner-occupied refinance. It was to restore your VA eligibility to then go do an owner-occupied purchase. So it's not to say you can't do it. You just have to build a strong reason for why. Preferably, you're moving to a bigger house, you're moving to a better neighborhood, you got a job transfer, and now you're moving somewhere else. Something else that strengthens the reason for why, rather than something that appears as though you just restored your VA eligibility to do another zero down purchase. So nothing that you're talking about doing is wrong. A lot of people do it. It just has to make sense to an underwriter. And people will always ask me, well, how are they going to know? Well, 20 years ago, you could go to 5 different lenders and get 5 loans at the same time, and no one had any idea. Today, I mean, it's been 10 or 12 years, there's something called the Mortgage Electronic Registration System, or MERS. Every loan has a MERS number, like early on in the process. So it's registered in a database. They know what loan you did, who you did it with, what you told that lender. Like literally, they don't have your whole file that they can look at, but they know the broad overview of what you've just done.
No, good stuff. And do VA loans still have so when you do a VA loan, you have entitlement, right? So you have a certain amount of entitlement, and in order to do another VA loan, you have to get your entitlement restored. And I remember at some point, like if your entitlement ran out, right, that you could no longer continue doing VA loans. So is there still a restriction on how many times you can use VA at this point, or is that's
No.
gone?
Just once you pay it off, you have to get it restored. And even if it's not restored, we request a certificate of eligibility and something happened, it didn't get processed, you can get it processed fairly reasonably through the VA.
Got it. All right. James wants to know if you can buy him a house.
James, that's a bold question. I don't even know you.
Can you? I mean, he's looking for an answer here. James, we're going to have to come back to you on that one. If you guys continue to throw money at this thing, we might be able to do that. Kaylee is asking how long should I expect in between offer acceptance and actually closing on my first home? So part of writing a purchase contract to purchase a home is, in there is something called the escrow term. At least on our contract, that's how it's broken down. And so that's the number of days that your escrow period is. And if you're in a state that doesn't have escrow, you have an attorney or what have you, it's might be called something else. But essentially, it's the amount of time from the day that you go into contract with the seller to buy the house to the date of close. So that's going to be laid out in the original contract. And so I would say typically for me, there's no hard fast number, right? There's no number that this is where they all close, because some can close in 10 days if it's a cash deal. Some might take 45 or 60, depending on what's being done there. But I would say the average for my clients is probably 30 days. So when we're negotiating an offer, we're asking 30 days. And what that means is from the date of acceptance till the day that thing closes, you get the keys is 30 days. So 1 month's time. Now, understand that can vary a little bit depending on a lot of different factors and what have you. But I would say that's a good number to keep in mind. And that's something that your real estate agent should ask you, right? Your real estate agent shouldn't pick that time for you. That should be your a question or something that you address when writing the offer. That should be one of the things that you get to pick how long your escrow period is, because some people need longer, some people want it sooner. But if you want it sooner or whatever, just make sure that your lender can accommodate those times. Can you give me a HUD foreclosure, any type of foreclosure here in Cache County, Utah? So the easy answer is no. I can refer you to an agent in that market that can probably help you find property. Now, finding foreclosures right now is like finding a needle in a haystack. For one, they're not really allowed to foreclose on properties at the moment just because of the moratoriums that are out there. With HUD or with Fannie or Freddie or what have you. So it's likely going to be a while before you see foreclosures start to hit the market. And even when you do start to see them hit the market, if they're priced right, they're going to sell just like any other property out there. And if they're priced below market value, it's going to be even a bigger, audience looking at those property. A bit more buyers are going to be looking at it if prices are lower on those homes. So I wouldn't count on foreclosures. I would just count on trying to find a good property in a good area where you want to live at a price you're comfortable with, and not focus on foreclosures, because I think
I always like to look, Jeb, at the question behind the question. No one wants a foreclosure. They want a discount. So
right.
They say, can you get me a foreclosure so I can get a discount? Well, you only get a discount on a foreclosure when there's more foreclosures than there are buyers. Always goes back to supply and demand. We've talked about before, I flipped a ton of homes between 2008 and 2011, and that was because there were a ton of foreclosures on the market and very few of us buying them. So because of that, we got to dictate our terms to the bank. In a current market where there are very, very few foreclosures and there's lots and lots of buyers, there's nothing special about a foreclosure that's going to make it sell for less. It generally goes into the MLS or to some type of auction like we see online now. It's advertised, people are aware of it, and it will get bid up to what the market will bear. So they are still subject to supply and demand just like every other home, and that's no different for short sales. There's nothing inherently unique about a short sale or a foreclosure that makes them sell at a discount in an otherwise strong market.
No, agreed. That was well put. Al is asking maybe basically why all the YouTubers out there are saying a 2021 market crash. He didn't notice it prior to this year. He doesn't see one happening in Colorado. I agree with you, Al. Most major metropolitan cities are very strong right now. Even the smaller cities are strong. And the reason is because it gets clicks, right? It's clickbait. It's clickbait. Very easy to advertise to people's fears and get people to click on it, right? If I'm scared about a market crash and that's what I believe, if you're putting that out there, then that's something that's going to feed my what I already believe, and I'm going to click on it. No different than politics or anything else out there that drives people's agenda. So not to say that you should just watch my channel because I give you my thoughts on a strong housing market. You should see other people's opinions, but you got a lot of people out there that aren't in the real estate business that are just talking heads that have no idea what the hell's going on in the market, preaching crashes just for views, and it's somewhat frustrating to some extent. So maybe talking about a stock market crash, housing market crash takes a bit of time. So yeah, I think you're more likely to see a stock market crash than you are a housing market crash all day. If I go conventional, how far did they go back in checking credit? And with FHA, how far did they go back and check for credit? So what happens is when you pull a credit report, now I'll let Josh jump into this because this is his expertise, but when you pull a credit report, it's going to show your history of credit, right? So they're not going to go any further back than the report that's up there, but essentially your credit report, anything that you've ever applied for credit that, car payments, student loans, credit cards, any of that stuff, whether it's paid off, you defaulted on it, you missed payments, what have you, it shows on your credit report. So there's a credit history there for your entire life, if you will. So they're not going to do anything, in addition to that. But, what happens is after a certain period of time, those older things don't count or affect your credit score quite as much. So if you've been current more recently and you've had things in the past, typically speaking, you're not going to have issues there. But FHA, essentially, they're going to go off that credit report, and they're going to take the middle of those scores. But Josh, why don't you add your expertise in there?
Yeah, 1,000%. The mortgage program doesn't dictate how you're going to look at credit. They all require a residential mortgage credit report. So you're going to pull a 3-bureau credit report. As Jeb said, you'll use the middle score. But more importantly, in terms of looking at data, the data included in that report is dictated by the Fair Credit Reporting Act. A bankruptcy is going to fall off after 10 years. A late payment is going to fall off after 7 years. So let's say you had a bunch of mortgage lates in 2015. It was only 5.5, 6 years ago. They're all going to show, but they're aged, so they're not as bad. Now, flash forward 2 years, they'll disappear. So you'll see a spike in your credit score. So if we're wondering, is there a way around credit by going one program versus the other? Nope, they're all going to use the exact same type of mortgage credit report, and they're all going to return the same credit score. FHA is going to be more forgiving in terms of what's in that report than conventional, but they're going to be the same report.
All right, there you go. All right. So Nancy is under the impression that in 3 months, but we'll continue to ask until close of loan. Maybe talk housing. I don't understand the question there. All right. Yeah, so we're going to go to another one here instead of reading that. Clipsum Easy. What is better option for someone currently renting? Continue renting for $1,600 for a 3-bedroom apartment, or buy a 4-bedroom house with a mortgage payment for $2,600? So obviously we don't know all the factors there, right? We don't know your financial position or any of that stuff, but understand like a $1,600 rent payment, and Josh is probably doing some calculations over there.
Yes, we are.
It is going to probably come up to a $2,200, $2,300 mortgage payment if I just had to guess off the top of my head. Now, Josh is going to give you some real numbers here, but understand when you own a property, there are tax deductions, right? You get to write off the interest on that property. You get to write off the property taxes on that property. Now, there are limitations right now, but based on the numbers you're talking, I think you're golden with, you could probably write off all the interest, all the taxes on the property. And then in addition to that, you get appreciation, right? So we've talked about this in numerous videos over doing these lives, and I've even talked about in other videos. There's a reason that homeowners are 44 times more wealthy, if you will, than those of renters. And it's because every month you're making your payment, you're paying down the principal balance of that loan, which is like a forced savings account. And in addition to that, you get tax deductions from owning a house. And thirdly, you get appreciation, right? So there's a lot of benefits to owning a property. But let's hear the real numbers there, Josh. What's $1,600 in rent and a $2,600 mortgage payment? Yeah,
so quick and dirty back of the napkin numbers, it's about a $500,000 home purchase. So using the numbers and going through just a recap of the same thing you said, there's no 30-year fixed rent. So that rent is $1,600 today. Next year, it's going to be $1,675. The year after that, it's $1,750. So if we flash forward 10 years, it'll be $2,400, $2,500, $2,600. Very similar to our 30-year fixed mortgage as of today. That's benefit number one there. The other is when you make your monthly payment every month, that $2,600, unlike rent, doesn't just go away. A portion of that, with interest rates being so low, is going to principal. Even in the early going on a $500,000 mortgage, you're going to have $600 to $800 a month going towards principal. So at the end of the year, you have $8,000 or $10,000 of mortgage pay down that you've now put into your home equity account. It's just like a savings account. It's harder to get money out of it, but you've got $8,000 over there. Again, with a $500,000 home, if it appreciates 3% this year, it's going to go up $15,000 in a year. So you've got $23,000 to $25,000 of appreciation and mortgage pay down that's now sitting in home equity that you have that you wouldn't have if you were renting. You don't have to worry about the payment going up next year. And depending on your situation, you may receive some tax benefits from it also. But those are all of the factors that over time lead to homeowners being 44 times greater net worth than renters. So the easy answer, if we just do a math equation, by all means, buy the house. Now we're talking about $1,000 differential between those. That's significant. Is the $1,000 going to allow you to live the life that you want to live? Are you going to have to rent a couple of those rooms out? Do you need that much extra space? There's a million questions behind it, but from a pure math perspective, buying the house is going to make you wealthier over time, assuming you can afford the additional $1,000 a month.
All right, there you go. All right, so I read through Nancy's questions here to get basically bottom line. She thinks the housing market's in a bubble. She's an investor. She thinks that a lot of rentals that investors own will be on the market the next few months due to loss of rent. I think you'll see some rentals come to the market when this whole thing's done. But you know, at the end of the day, I think there's a lot of renters, a lot of homeowners have equity in their property. A lot of people were able to take forbearance. They were able to push the payments off. They're still due. Yes, you're going to have property come to the market, but again, I think buyer demand's high enough that it's going to, you know, those properties will get picked up just like any other property, and the market's going to continue to move forward. So I don't think it's going to create this massive bubble to burst, if you will, just because investors list property for sale. C. Rivera, I'm understanding that with conventional, they want the last 12 months of credit to be flawless, no missed payments. And with FHA, they want 12 to 24 months to be flawless, no missed payments. Hop on that one.
Yeah, neither one of those are accurate. So someone's giving you partial information, but in general, neither one of those are accurate. For a conventional loan, if you have a mortgage, you can only have had one 30-day late in the last 12 months, and you cannot have had any 60-day lates. All consumer debt is treated in the overall scope of the picture, and the automated underwriting system will tell you whether you qualify or not. We've had people qualify with a mortgage late last month. We've had people qualify with credit card lates or collections within the last year. And if anything, FHA is much more flexible than conventional. So just take it with a grain of salt where you're getting the information, because really nothing could be further from the truth on those. But what I would say is if we have issues within the last 12 months of paying bills on time, we probably should think really seriously whether now is the right time to buy a home. If we can get 12 to 24 months of clean payment history, clear up any collections, charge-offs, get the scores up, get some money saved for a down payment, and hopefully some reserves after closing on the home, I'd feel much more comfortable about that versus racing to get into a home when there may be some credit issues. But in terms of can you do it, you absolutely can do it.
All right, we're going to take one more question here because we're pushing on an hour. Let's see. I'm going to go to somebody that because a couple people are asking questions over and over. So John here is asking, is there a mathematical formula on how much PMI is based on the borrowing amount?
I absolutely wish there was. It would make our life much easier, but unfortunately, we have to go to a calculator. We have a couple that will basically price out every mortgage insurance company in the market and let us know. For the most part, the rates are very similar from one to another, but there can be substantial differences. And what we have to do is we have to tell the calculator what type of automated underwriting system is being used, purchase or refinance, credit scores, one borrower, two borrowers, first-time home buyer, all of those things, and then it spits out the rate to us. So unfortunately, there's not a math equation you can use to determine the mortgage insurance. In general, the more you put down up to 20%, it's going to go lower. The more borrowers you have on the file with good credit scores and higher credit scores, the better, to the point where if you have two borrowers with 800 credit scores and 10% down, the mortgage insurance is going to be really, really minimal. If you have one borrower with a 640 credit score and 2 or 3% or 5% down, it's going to be a really, really big number.
Oh, good. I'll do one more here. We got Zero Lou ones. I don't know. I probably just, you know.
I think he couldn't get Zero Luis, so he went with Zero Luis
there you
with a
go.
one.
Look at that. It's like reading a license plate, man.
He's the number one Luis. I like that.
This is like going down the road trying to figure out what the license plate means. What is your opinion on $130 per month HOA? I think the easy thing here is what does the HOA include, right? In different markets, different areas, HOAs are going to be different. But what does the HOA include, right? I mean, a lot of places in California, we'd be thrilled with $130 a month HOA, but if it's not covering anything, then it's irrelevant. But if you can find out, not only how much the HOA is, but how well funded the community is, all of that stuff, because you want to make sure that, as a homeowner, you're not buying into a community where they're going to start doing assessments or start adding to or raising that HOA quickly or what have you to do repairs within the community or what have you. Typically speaking, at least in California, if something has $130 HOA, it's basically just covering the common grounds of the community. It's not going to replace roofs. It's not going to do a lot for the property itself, but I'm not sure where you're located. So, make sure, you're working with a real estate professional. They can answer a lot of those questions for you. They can help you understand where that $130 a month is going. And it might make more sense for you depending on what the community offers. But outside of that, it's hard to address. So we're pushing on an hour here. What we're going to do is take any questions this week, throw them into next week. But if you want to get connected with a lender, you have questions about real estate, what have you, reach out to us directly. Josh, you can throw up a banner there if you have one.
Let's see if we can find it. Oh, we'll go to the other banner first. Wait, where did we put? Here's the one. Here's the one we're looking for. Email
addresses. Email myself or Josh if you have questions about real estate or loans. A lot of you guys reach out. We connect you all over the United States for financing and for helping you find a real estate agent. So take advantage of that. You got two guys here that are willing to help, guide you in the right direction just to make sure you're in good hands. So feel free to contact us. Josh is starting a channel himself as well. So we're going to throw up a YouTube link here and I'll put the description in the video. But if you just search Find My Way Home on YouTube, it should pop up. So help him get some subscribers and grow his channel as well. But for now, we appreciate you guys taking the time to watch. Josh, any parting words there?
No, it's been an interesting start to the year. I never like the first year of a new president just because there's so much uncertainty. Doesn't really matter who the president is. It's just the changeover. We have a fairly solid idea of what Biden would like to do. We don't know what he's going to get to do, and we also don't know what effects that's going to have on the economy and the markets. So just uncertainty. So tune in, keep watching. We'll have updates, and it's best to not guess or worry about it too much. Let's just watch what happens and see how it impacts you as a homeowner, a home buyer, or a potential home buyer.
Absolutely. So thanks again, guys. We'll be here next week. Adios.